welcome back to SureFire Live. I'm your host, Mark Stoner. I have switched rooms. The regular office that I'm in, my house is under full renovation, and I can't even be down where my office is. We are redoing the floors, redoing the kitchen, so it's a little rough to live in my house right now. But thank you guys for joining me tonight, an hour later than normal. I had to travel today, and we were at our office in Charleston, so I had to catch a flight back here, and I knew the time was going to be a little bit off, but thank you guys for joining us. Looks like we got a nice little crowd gathering. So tonight I've got a friend of mine, a new friend. He and I met at an IndyCar race in Nashville. We just happened to be in the same, the same area. We were sat across from each other and just started talking, and we were F1 fans, and he was in, he knew a lot about my type of business, and we could have talked all day long and forgot about the race. But anyway, he's my guest tonight, Garnett Decosmo, and he will be talking business. Before we get to that, I wanted to talk about SureFire Training Academy. One of the things we've noticed a lot is people think, well, it's busy season, therefore I don't need to train my guys. We're so busy. And we've noticed in subscriptions and other things that some people like pause or they wait. And, for us, we're like, that's the perfect time a lot of people are hiring a lot of people right now. The time you're ever going to train them is now when you're bringing them on. And also, when's the best time to train them? When they're going to be, before a slow season and they don't get a chance to use all these things, or train them right now and they go out immediately and can put these things into practice. So our point is, if you're having trouble training new people, contact us. We've got some great systems for making sure your people do the training, making sure you can track it. That's one of the great things about SureFire. It's very trackable. And they might not be certified, but if they are certified, they get more CEUs. But one of the hardest things that we hear is, I can't get my guys to do the training. Well, that's a management leadership thing. If you believe in training, then your people will train. If you kind of believe in training, they'll kind of train. And if you would like to just buy training and hope they do it, they're not going to do it. So let us help you with that. We've got some proven systems that can make sure your people get trained right at the time when they're going into battle. All right, so I'm going to bring Decosmo on. Let me check my comments. Let me see. I got a couple comments. Hey, Mark. Hey, Trenton Nelson. Did you go to Spats Community this year, Trenton? I don't think you did. Trenton has quick story about Trenton Nelson. He chimney sweep. I believe you're still in Colorado, but we went to Italy a few years ago to the chimney sweep parade. If you've watched the chimney sweep festival. And Trent had the best beard. He had just a huge beard, and he had people were coming out. They were all over him because he looked awesome. And these people are going, yeah, he said, yes, sir. I've never seen, my son went a few years ago and he had a lot of girls around him. Trenton had everybody wanted to be around Trenton, and they wanted to be around him and sign autographs and take pictures with him. It was super cool. So Trenton, good to see you. Thanks for being on tonight. Chuck Hall, my friend Chuck Hall is on. He says, looking forward to content tonight. Me and Chuck have been talking a lot about buying and selling businesses, so he was looking forward to tonight's content as well. Let me check a couple more places. Chad Murray says, hey, man. And Cynthia Snyder, hello. And so, all right, let's get this thing going. I'm going to bring him on. Here he comes. Garnett, how are you, buddy?
Mark, I'm great. Good to see you.
Good to see you, too. It's great to see you again. Hadn't seen you since, the race.
That's right.
Tell me about you being a race fan.
Well, I'm kind of ashamed to admit that I am a bit of a bandwagon fan. I think, it was back in 2015 that I really kind of got into Formula One, and then I fell off a little bit. And then, the Netflix Drive to Survive came back out, and it really kind of got me back into the sport. And it's just been off to the races since then. So to speak. And my wife, she's from Tri-City, so Bristol area. Her dad drove stock cars. Amateur, but as she was growing up, so she's really got motor oil in her veins, and so it's you would think that it might be me dragging her to races or to watch, but she has got the entire weekend planned around Formula One when the races are going. So
have you ever been to have you ever been to a Formula One race? I have not. I've only been to IndyCar.
I think we've got one foot in, just booking tickets to Las Vegas next year when the race is there in November. Now we don't have tickets yet, but we're going to try. But otherwise, I don't know how the chimney sweep parade that you were talking about earlier in Italy overlaps with some of the races there, but seems like a great excuse to knock two things out at once.
It did overlap, and one of my friends, that he might be on tonight, he stayed for the Chimney Sweep Festival and then went to Monza. And I see Jasper Drangler, who is a race car driver. He said, now we have his attention. He's on another one of my feeds. And then I don't know who this is, this Facebook, Super Max. So,
oh boy.
Max is killing it, man. He is killing it. The reason Garnett and I started talking is because he had a Ferrari hat on. I'm a Ferrari. I like the Ferrari drivers, but man, Max that Red Bull team is they're crushing it this year.
They are. And I'm glad that this is a live stream so the Red Bull fans can't pop the orange smoke in the middle of our discussion here like they do in the races.
They're very rude. They're all about it. So, well, man, so let's just talk, in my industry, and I know you don't know my industry, but there's a lot. Oh, it's Scott Scraper. Hey, Scott, good to see you, buddy. So you're a Max fan, Scott. Man, it's hard to not be a fan of that guy. Yeah. He is driving so well this year. But so we started talking about businesses, and in my industry, there's almost two groups of people. There's an old school group, and I would have to say I'm part of that, where we started back in the 80s, some even late 70s, 80s, and a lot of us are getting older. But a lot of us didn't really build businesses. We didn't know this thing could be a business, right? Chimney sweep, who would have thought? But some of us did build businesses that are sellable. Some of us, the next kind of generation, I would say, are really interested in building businesses more so than just building a trade or a job for yourself. And now the talk of how do we get out of this thing that we've built? And then some of us are on a 5-year timeline, 10 years. Some guys are retiring now. This last year, I probably had 4 or 5 people call me and say, Mark, will you buy my business? And they didn't have anything to buy. I didn't have anything. It was hard because I liked them. I knew them personally, but there was nothing that I could help them with. And literally one guy was in tears, like crying that he'd gotten hurt. I think he was about 65. And he's like, man, I need you to buy my business. And like, it was a West state that was not very populated. So let's talk about that. You and I started talking about it. Let's talk about with me particularly, what do you do for buying and selling business just as your job? How does it work for you?
Well, so yeah, it's we're the advisor for someone who is looking to sell their business, and it's not even just selling their business. If you've got a growth strategy and you need capital, we can help with that type of work too, and that could be debt or equity. But typically we will be approached by someone like you who is an owner operator. They started their business and they're having a similar thought process that you are. What's next? What am I going to do with this business? It's either, I'm getting to the point that I want to retire and I'm looking to buy an RV or do something else with my time, or, I've put a lot of risk at stake with this business and I'm just kind of ready to walk away. I'm sick of having the PGs. I'm sick of having so much of my wealth tied into growing the company that I have, and maybe it's the right time for me to think about exiting. So, what we will do is help think through that process. What is it that you actually want to accomplish? And so a lot of this will come down to really the seller understanding themselves, their business, and what they want out of the transaction should it occur. And, I think one of the problems that we run into a lot, it sounds like, with the discussions you've run into this as well, is the thought process about selling a business starts right about the time you start trying to sell your business.
Right.
And it's you run a business, and you said this exactly earlier. It's if you were intending to sell a business and build a business to sell, you're going to run it in a way that is probably going to be a little bit different than if you're a tradesman. you know your trade, and you're trying to help as many customers as possible, and you're just growing because you love what you do, and you enjoy being successful at what you do as well. The considerations are going to be different, and you can't just wake up one day and say, all right, I'm ready to go to market and sell my business. And there are a whole lot of considerations that go into play. I can walk through them now. We can get to it later on. So, I think one thing that's, you need to think about is your accounting, first of all, right? When you go,
what's that?
Yeah, right. It's something that you don't think about until it's too late. But, it's best practices, I think, at any stage of your business to really think about bookkeeping. How are you tracking your expenses? How are you tracking your sales? How are you tracking trends? And then how are you not only collecting that information and using it to your advantage, but then how are you setting your key financial metrics? How are you setting your growth forecast and say, I know in a recent discussion, you were talking about getting to that $1 million year and then say, well, I want to hit a 10X. I want to get from 6 million a year to 60 million a year in a handful of years. Well, there are certain strategies that you can put in place to do that. But if it's garbage in, garbage out. If your accounting is not accurate, if you're not doing that correctly, you're not going to be aiming for the right target. You might not know where. Yeah, go ahead.
Well, let's talk about that, because a lot of guys, especially blue collar guys, we didn't get into this thing to be accountants. We didn't get into this because we were good at that. We got in it because we were good with our hands. We were good problem solvers. We could get stuff done. And that was always secondary for a lot of people. Now, there's a guy on here, Chuck Roydhouse. It was always first with him. But for me, it was like, I'll get to that later. I'll figure that out later. I'll figure out my costs and I'll try to not pay taxes. Like, I'm going to do my best to make my taxes look like zero, so I don't want to pay anything. But when you're coming to sell business, that's like the worst couple of things you can do. Is that right?
That's right. And it's not only because it's going to impact the way that you grow your business and you execute on certain growth strategies or investments that you're going to make, but it's also going to impact the process that you'll get taken through when trying to sell that business. And we can go through the whole process, but ultimately a big part of that, and it's the most difficult part typically, is the due diligence phase. It's when you've found the person or the group that you think is going to be the right buyer. You go under contract with them under an exclusivity, and they they have access to all your books, access to your financials. They get to see everything. And if those financials aren't clean, if they're internal and they haven't been kept well, you don't have a controller or somebody focusing on it, that's going to be a lot of headache for you, because they're going to want to see, okay, you said that you made this much last year, but I'm looking at your income statement, your P&L, and I'm looking at your trial balance, and I can't trace back and see kind of where these sales are flowing through to your income statement. I can't see how these expenditures that you're reporting are flowing through to your P&L. And if you run into that, it's just, it becomes very difficult, because you have to begin to support those financials that you provided. And it puts you in a position as well that if, let's say, your sales were overinflated, let's say the timing was wrong, you might see that your sales, your EBITDA that they're valuing you off of is going to get discounted, and that's going to hit your valuation.
Tell everybody what EBITDA is. I know that's your number one thing, but a lot of people on here may not understand that and why that's important.
Yeah, so EBITDA it stands for earnings before interest, taxes, depreciation, and amortization. Basically what it is it's a way of calculating your operating cash flow, less taxes and interest. Essentially what a company is going to do or a buyer is going to do is they're looking for a benchmark that they can use to compare you against others in your industry. Because, if someone is looking at buying you, expect that they understand your business pretty well. They understand your industry, and they're going to be looking for a metric to compare you to others. And they're going to use your EBITDA typically as a way to do that. They use that because, they're going to finance your business the way that they want to finance it. They're either going to use equity, and probably going to use a combination of debt, maybe up to half of what they use to acquire you, they're going to use debt. So whatever you're paying in interest to finance your growth really doesn't mean a lot to them. Depreciation and amortization, your depreciation of your fixed assets, like your vehicles, that's not going to impact That is not a cash expense. So that doesn't impact their ability to generate cash flow, either for their investors to finance growth or to pay off some of the debt that they're going to be incurring in the acquisition of your company. So it's a rough way of doing it. There are better ways to value a company, but because it is a kind of universal metric that can apply, allow them to compare you with others in your industry, it's just what they tend to use. And when it comes to the valuation, what they're going to use is a multiple of that EBITDA to establish what a valuation is going to be. And they're going to come up with that themselves. There tends to be a range from one industry to the next. And in many ways, although there are multiple components, will reflect the stability of your earnings over time. So a manufacturer making widgets and that has customer contracts year over year over year, they're probably going to have a pretty solid multiple, because the buyer is going to know, if I buy this company now based on their growth over the last 5 years, and I see their forecast, I can reasonably expect that's going to be the return. That's going to be the performance that I see, and I can estimate what my return is going to be. On the other hand, and I think this is an issue you guys probably run into in services a lot, if you are generating a lot of your sales and revenue off of one-off projects, and it's not necessarily off of maintenance or service contracts, they're going to look at your sales and say, well, okay, you said that you earned $10 million last year, but perhaps, you were coming off of earning $3 million the year before, and you had some great contracts that came. What assurance do they have that once they buy you, that they're going to continue to see that type of revenue growth that you might have had in the last few years? So
that's an excellent point. You're right about our industry, that we're one-off projects. The majority, my company handles 300 unique customers a week. The majority of them are one-offs. We are learning to, do maintenance contracts and do some of those contracts. But to your point, it sounds like, our industry, to get more value over, like the HVAC industry, they are very heavy into home contracts, and that's how they value their businesses. And we haven't really gotten good at that in our industry. There's some companies that do it a little bit. We do it a little bit, but it sounds like would you say if there's one thing to focus on, that would be a major one, or would there be other? Well, I'll tell you what, let me just back up. Don't answer that. This Chuck Hall, who's very interested in this, he's coming to a time frame where this is in his pipeline. He's not super close, but it's in his thought process. How do you value a business, and how do you know you have something to sell? At what and how many millions in revenue do you have something to sell? Because I've been told, like, at certain 1 to 5 million at small cap and then mid cap companies, and then there's certain levels as you go higher, they have higher multipliers. Can you talk about his question right here?
Yeah, and it is a bit of a difficult question to answer, because there are a lot of ways to skin that cat, so to speak. Not the best example, I guess, but there are a lot of methods that you can use to approach evaluation, right? The IRS, there's discussion in the news sometimes about how does someone value their assets when they're talking to a bank or a lender or someone in one market trying to determine a fair market value, or if you are valuing something for the IRS. The premise of the value is going to drive somewhat how you arrive at that valuation, because not every valuation is going to have the same premise to approaching it, right? So if you say, I'm going to go out to the marketplace right now and I'm going to try to sell my business, well, the best way to find the valuation is running a process and seeing what the market is willing to bear for your business, which is typically the way that we run our process. We will give a sense to our clients. This is what we think you could be worth, and that's looking at comparable transactions, right? Let's look at a business that's similar to yours, that's sold recently, and it tends to be public companies. So in certain industries, this is harder to do, but you'll look at, okay, well, what were the multiples that were received for these businesses that are similar to yours? And you'll apply that to the same metric. So let's look at what the EBITDA multiple on a recent transaction was, maybe get a range of those and say, okay, here's about where we think you can land. You could discount cash flows. That's another way to do it. You can look at assets and net assets and say that's one way to value. But there's really, like I said, there's not necessarily one way to do it. But I think if you're looking for a market valuation, what are you going to be worth to a buyer? It is trying to get an understanding of where have previous transactions been in this space and how similar am I to those, and will I be able to receive a similar multiple? But it is going to be basically, for a lot of purposes when you're trying to sell, it's going to be that question of what's your EBITDA and what's the multiple that buyers are willing to apply to it. And it's kind of hard. Like for our purposes, we won't tell a buyer, we think you're worth X typically, unless they want an actual valuation, because we don't want to be in a position to assume what the market is willing to pay for a particular business, because there are a lot of nuances to every business. It's, what do your customer contracts look like? What do your customer relationships look like? What does your management team look like? How deep is your bench? And it goes back to the earnings. How stable are they? A buyer's going to evaluate all of those different things when they're trying to figure out what that multiple is that they're going to apply to your EBITDA. And that's not to mention that your EBITDA is something that can be adjusted. So it is not just as simple as saying earnings before your earnings before income or interest, taxes, depreciation, and amortization. They're also going to look at things like, do you have a nephew or a member of your family that works for your business and they're on the payroll, but maybe they're not doing a whole lot. And once the transaction's closed, they're probably not going to remain on the payroll. That's what we would call an add back, right? So you're going to add that salary back because that individual, that salary is probably not going to get paid by the next buyer. Now that can cut both ways, right? So let's say you're real happy that your PPP loan got forgiven this past year or back in 2021. Well, a buyer's going to look at that and go, well, your PPP loan, if you include it in your income, that's not going to happen next year. So we're going to back that out of your income next year. So
interesting. So
it's a roundabout way of me basically saying, for the purposes of figuring out what your company is worth when going to market, we're not going to tell you that. The market's going to tell you that. We're going to run an auction process where we're going to find as large of a universe of buyers that are going to be able to come to you and say, this is what we think you're worth, and what the market bears. That's the ultimate value that exists.
Yeah. What's your value? Yeah. What's your business worth? What somebody's willing to pay for?
Yeah.
But so some of the people are like, hey, I'm hoping to retire with X amount of money. And I was at a business sales thing a couple weeks ago, and they said, you may want to run this test run now, way early, and get an idea, and then also figure out what it uncovers, what you may need to work on, what your value is, and then you may have to learn what you need to do to get that number you want to come out of this with. Is that good advice, or what do you think about that?
Yeah, I think, running a full process, I wouldn't recommend doing it unless you are very serious about selling. I think, talking to an advisor, I think this does come down in a lot of cases. You got to have the right advisors around you, whether that's your accountant, your attorney, your wealth advisor, your ultimate transaction advisor, like we would be, someone that's going to know the industry that you're in very well and be able to give you a sense of maybe what you could expect. Today, I couldn't tell you really what I would expect a multiple to be on a company like Ashbusters or some of the folks that are on this call. Like you said earlier, these are not transactions that I personally have had a lot of involvement on. But there are those out there who do focus on these types of transactions, and you can go to them. So we've got an affiliate, for instance, that has sold several HVAC services, commercial and home services companies over the last few years. There's been a lot of roll up, and you kind of mentioned it earlier, in that industry. They've got a great insight into the types of multiples that folks are seeing. So, knowing who to talk to. And finally, I think, and this is all unsatisfying for sure, but great folks to talk to are other folks who have sold their businesses recently. So, right. What you're doing here by hosting these calls, by bringing people together who are all running similar businesses or owning similar businesses, as they exit, as they sell, find a buyer, figure out what the next step is, continuing those conversations with them to say, hey, what happened? Right. What was the valuation you got? There's no better source of intel than when you've got a network of people who are in and out of the industry.
That's it. That's good stuff. Well, to his second question, how do you know if you have something to sell? Like, is it still market based, or is it like, I know if I do $1 million, I should be able to sell it for X. Or if I do 10 million, there's going to be a buyer. Like, how do you know if you got something to sell?
Yeah, it's a good question. I think scale is always good, right? I mean, if you can say that I've achieved $10+ million in revenue or $15 million in revenue, you don't do that by mistake, right? That is because you have run a business that's sustainable, that you've been able to achieve a certain level of growth year over year. So, there's not a certain level at which I would say that is the right time to buy, because there are buyers at all levels. There are independent sponsors, folks that are out there who might have owned a business previously and they made a little bit of money. They've got some experience operating, and they're sitting there saying, hey, I'm looking for a business that might have $1 million in EBITDA that I can perhaps spend, $5 to $7 million. I'm going to buy it and then I'm going to run it myself. That's very different than selling to a large multinational company that is going to have a very different expectation of the type of company that they want to buy. So to answer that question, I wouldn't say that there's a right answer to it, because there are buyers that will buy at all levels. But what you need to ask yourself is, well, what is it that I am selling? It's sure you're selling, you've got a sales number and you've got your EBITDA, but ultimately, what is it that you sell? Is it the customer relationships? Is it the geographic domination? Is it the reputation that allows you to continue to generate sales in a sustainable and growing manner year over year? Think about it like that, because ultimately, it is your ability to generate sales and profitability over time that is what you sell. And every company does it differently. But if you can do it sustainably and show a way that you do it, again, those maintenance and service contracts, if you've got a lot of those existing, that's sticky, right? Once some of these big HVAC companies sign someone up for a maintenance contract, how long do you think they keep them? I'm guessing it's a pretty long time.
Right. They do.
And how much do they upsell those folks for different services?
Right. Yeah.
They do it all the time.
It's an invitation to another sales guy to come to your house, is what those contracts
are.
Oh,
yeah, 100%.
But you're right about that. I mean, they all focus on that, and we have to learn and do better in our industry, because that will help us sell for more. But to that point, how much is it the value of the business, how much the owner is involved? Like, when you're looking at that, and how much of the value comes with, how much the guy is in or out of the business?
It is case by case, and it's important that the owner knows what they want their role to be later on. In a lot of cases, particularly with private equity, if they're buying a company, and it's not always the case, but they're not always operators. They can bring some level of expertise. They can bring capital. They can bring some know-how, sales channels, something like that. Or they bring a platform and they're going to add you on, and then it looks a little bit more like a strategic. But in many cases, they're going to rely very heavily on existing knowledge and expertise that is in the company. So whether that's you as the owner or your bench of managers and supervisors that you've mentored, you've elevated, you've given them a way to understand the way that your business runs, that's a factor that will likely be weighed. So owner involvement is important, but it's only as important as their ability to delegate work and have a bench of management that can take over if they were to step away.
When I was talking to a guy about buying business, he said, none of these guys want to buy your job. They're looking for a business that's going to fling off cash, and they really aren't trying to buy a job. And to your point, you talk about private equity people, and then like strategic partners, where somebody might buy your business. That's in my case, say a big HVAC company wanted to get into chimneys. They said, hey, we want to do what you're doing. And then I believe they call that strategic purchases, and others are private equity. So just talk about that for a second, because like in private equity, they're going to try to lock you in to stay in there to make sure it runs, if I understand it right. And strategic may or may not need you because they understand what you're doing.
Yeah, and it depends. It's case by case, right? So private equity can resemble a strategic in a lot of cases, right? Because they will have a platform that they've already invested in, and now they've got a thesis that they're going to expand either geographically or they might say, well, I see Mark's, let's say, yeah, they buy an HVAC company. They say, well, I want to add chimney sweep to my services that I offer. So I'm not going to do that internally. I'm not going to do it organically. I'm going to buy your business.
Right.
And I might integrate it into my current platform. So yeah, I don't necessarily need you as the owner to stick around, although I really need your team and I really need your management, your supervisors to continue to deliver the quality and maintain the reputation of the business in that geography, or however the motivation for that sale is. Now, on the other hand, if you are being acquired as a platform, and let's say somebody knows knows services, they know chimney sweep, they know home services, commercial service, whatever it might be, but they've got a vertical that they know that they can invest into, they will likely lean on you a little bit more in that case, because they won't want you just walking away and they have to take over, particularly if you are hands-on day to day. And there are certain ways of doing that, right? They're not the favorite. There are earn-outs, which, let's see if you can, we're going to hold off some of what we pay you to see that you can actually achieve the performance that we expect. Another great way to do that we see a lot of is the opportunity to roll equity. So it's not 100% buyout of the company, but they might buy your company and then they're going to give you a small, or sometimes a fairly sizable minority stake into that new company, because that's going to align your incentives to ensure that you continue to succeed. And then there will very likely be a non-compete that comes along with that, because they don't want you going out and starting a brand new company.
Right.
And if you are interested, they'll probably pay you a salary to keep you around as well. These are all parts of negotiations that happen throughout this entire process. And I, maybe it's helpful to kind of walk through how the process typically works if you're taking a business to sell. I don't know if that would be helpful or not.
Yeah, let's do it. Yeah, take everybody through. I know that you can't say this is how it's going to work for you. You just have to kind of give general advice. And it sounds like everybody needs to put a team together of trusted advisors, accountants, mergers and acquisition people as your team around you as you go to market. But yes, please, walk us through it.
Yeah. So there are a couple options. There's the investment banker like we are, and then there a lot of folks will use a business broker. There's not a large difference really between the two. Business brokers they tend to not be licensed, and they're going to work with very small founder-owned companies. They will probably have a list of local buyers that are likely to buy. So the universe of potential buyers that they're going to bring you tend to be a little bit smaller. They might list it on a website. They might actually give you a valuation of what they're going to go to market with.
I've seen people do that. Yeah.
Yeah, and it's right in certain circumstances. I wouldn't tell anybody whether or not going with a banker or a broker is the right move. What an investment banker typically is going to do is to run a bit more of a robust auction process. So we'll talk to you. You come to us, say, hey, I'm thinking about selling my business. We're going to discuss, is this the right time? Do you need a little bit more time to boost your earnings, get some things in place that are going to really maximize your value and get you ready to go to market? If you're ready, then we're going to negotiate the terms of our engagement, which and this is very similar between brokers and investment bankers. We're going to work on a commission, right? We're going to set a bogey somewhere and say, we're going to, a percentage of this, if we get you this value, we'll set a certain percentage there, maybe another escalator if we get you past a certain hurdle. And you can structure it in a lot of different ways. That's going to be part of a negotiation. Us personally, we always insist on a retainer. Retainers are a great way of aligning interest through this process, right? Because we don't want to go through this whole, what can be a 9-month process from start to finish. We don't want to get 7 months in and you say, hey, you know what? I don't think so.
Right.
So if there's a little bit of skin in the game at the front end, we view that as an alignment of interest. And we'll always say, well, whatever our success fee is at the end, we're going to net that against whatever you paid in this retainer. So just a little insight there. Once all that's agreed upon, what'll happen is you're going to get a document request list. We're going to say, hey, we need financials, we need your operating agreement, we need your head count, your org chart, your products, your asset list, all that kind of stuff, because we're going to try to start building an understanding of your business. Because what we're going to do is we're going to put together marketing materials. what's called a confidential information memorandum. Basically, it's going to give an overview of your company, your name, what you do, what your goals as an owner are, what's the opportunity here, what it is that to the question earlier, what are we selling, right? What is the story? It's also going to be the financial background. It's like I said, it's marketing materials to get a buyer interested. We're going to lead that off though with a teaser, which is going to be an unidentified or de-identified SIM, one page. Send that out to a list of buyers that we're all going to agree upon. For us, we tend to shoot for about 100 buyers that we're going to send teasers out.
Really?
Yeah, because we've had it in numerous cases because entrepreneurs tend to be pretty confident in what they do, right? They know their business, they know their industry, and so they'll come to us and they'll say, "Hey, you know what? I know who's going to buy me." Right. There are 3 competitors out there that I know are looking to expand, and they want to do what we do, and so they're probably going to buy it. Say, okay, well, that's fine, but we're going to put a list together anyway. 9 times out of 10, those guys never show up. Right.
And what they didn't even expect.
That's right. They're not looking, but also because you tend to think a strategic's going to buy you. Strategics are in the business, just like you, of running their business. Private equity, they're in the business of buying businesses. So they tend to be very responsive. They're always looking out for new opportunities. So just keep that in mind. If you think you know who your buyer is going to be, you might not. But anyway, we're going to send that list out. We're going to send the teaser out to that list of 100 or so potential buyers. We're going to include an NDA in there. We're going to say, if you want to learn more about this company, sign this NDA. They sign it, then we send them that SIM, that confidential information memorandum, which will tell who it is and give all that detail I gave you earlier. Through that process, as the advisor, we're going to be the ones who are talking to those folks. They're going to have questions. They're going to say, okay, well, I see here in this SIM that you sent us that they do X, Y, and Z, but what about this? Because they're going to have questions that are a little bit more detailed than we're going to lay out. You're going to have an advisor that's a middleman. They're not coming to you to bother you on that stuff. But we'll get to a phase where, let me go back. When we send the SIM out, we also send a process letter that lays out how this process is going to run. What are the milestones? When do you need to have your indication of interest in? When do we expect to have letters of interest, which are kind of that exclusive agreement that's going to take you into due diligence and get you on the path to sell. So we'll negotiate, we'll work with those buyers that receive the SIM and have questions to get them up to that point where the indication of interest are due. And at that point, we'll expect that they will send us a document that basically says, it's non-binding. It'll say, here's the range of valuations. And it gets to, I think, was it Mark's question earlier about how do you know the valuation? This is when we really start to figure out where the values are, because we're going to hopefully have a significant portion of those buyers that we sent out come back to us and say, here's a letter, our valuation range of what we think we'd be willing to pay. Granted, we need to learn more. This is how we'd finance it. Do we want that rolled equity? Do we want the owner to stay involved? And they're going to tell us, here's where we're going to source our debt from, because we want to make sure that if we're going to let somebody get further along in this process, that they can actually finance the deal that they're talking about. So once we get to that point, the due diligence starts to pick up a little bit. We're going to start talking to them. We're going to have a data room that's going to have a little bit more information that they can start going through your financials on a little bit more granular level. They're going to maybe have a conversation with your management team. Might be informal, online, not in person. We're going to whittle it down to 3 or 5. Get up right to that LOI stage where they're actually going to have those meetings in person with you. They're going to see your facility. They're going to see how you run. They're going to get to open up that hood a little bit more. And then we're going to say, all right, sharpen your pencils, submit your LOI. And that LOI, that's the binding agreement. That's where they actually give you, this is the valuation. This is what we're willing to pay. And there might be some negotiations there. Say, hey, look, you're off the mark, right? We've got 2 other buyers here that are coming in. Let's say they're putting a 7 multiple on. You're at a 6. You got to come up a little bit. The other part of this too, and I think this gets to some of the other questions, is not only are you looking at the financial terms, but because you are having these conversations with them, business owners also have a lot of other considerations, in my experience, than just the financials. And you can tell me if I'm wrong here. You tend to care about your team. You want to know that they're going to be taken care of. You're going to want you want to know that they're going to have a job, that they're going to be working for somebody that is continuing to take care of them the way that you took care of them. If you're operating in a smaller community, you want to make sure that, you know, it's not some corporate raider that comes in and strips everything out, sells all the assets, which doesn't happen as much as you might think. You care about your legacy. So there are all these different things that you as an owner are going to be weighing throughout this process. But once we get through that, you'll settle. You'll determine this is the group that I want to go with. You'll go under LOI. The due diligence starts. That's a painful process. It's when everything can fall apart, because that's, like we said earlier, they're asking you questions. They're saying, "Hey, why'd you do this?" And you're an owner of a business. I should say, you don't get asked by somebody else why you make the decisions you make that often. It kind of try, and it's not like they're second guessing. They really do just want to know. They want to understand, how did we get to where we are? But it's a difficult process. They're going to ask for all this information. I've seen deals fall apart in due diligence. And the way that I explain it to people is, this is like your final stage interview. This is where people want to see not only who you are and what you're capable of, they want to see how you operate under pressure. And it's particularly important if you're rolling that equity and you're staying involved. If you start getting frustrated and you start saying, well, I'm not giving you this, I've already given you all this other stuff, and when do I get to look at your books and all that? At some point, they're going to say, well, that's not how this works.
Right.
We're buying you. And sometimes they'll give a little bit. And if you're rolling a significant amount of equity, you should expect that you'll at least have some insight into their plans and their financials. But all that to say, you get through due diligence, you've got your attorney, which hopefully, what we tell folks is, we're not your attorney. We can recommend one, but if you have a transaction attorney that you know and trust, they should have been involved in this process, at least from the IOI to LOI stage, because they're going to be drafting up those sales documents, this purchase agreements, the disclosures, all that. You don't want a litigator in there. Another point, because litigators are like a hammer looking for a nail, right? They're looking to argue every point. There's a materiality. There's a way that transactions work. You're trying to get over the finish line. That's why deal attorneys, commercial attorneys, tend to be better suited than a litigator might be.
Interesting. That's good information.
It is. Well, hopefully. And so anyway, that's a long-winded way to get through due diligence, you get to the end, and if everything works out, if the earnings that you gave them, the EBITDA, all that is what you said it was, and they're able to get comfortable with it through their quality of earnings process and everything else, then hopefully you walk away from that process with closing that transaction with a little bit more money in your pocket. So
fantastic. So lots of questions on that run through, and thank you for that. It makes a lot of sense. But when I was listening to you talk, I seem to think, now I understand the majority of our chimney businesses, the people that are watching it in this industry, are under $1 million. For sure, under 5 million. The vast majority of our industry is that size industry, and there's a lot of fast growing companies, and we're getting better. Let's just say. That being said, there seems like, to do all that you just talked about, there needs to be a certain level of value for the company to go through all that. Because a lot of guys just like hand it to their kids, close the doors, sell it for, self-finance it. Like what you said was a process that seemed like there had to be at least, I don't know, a certain size company on the table to go through this. What would you say that's fair, or is that it's still in?
Yeah, I think that's absolutely fair. I mean, there's a certain point at which, if you're $1 million in sales every year, you're not going to want to go through that kind of process.
Right.
You might be able to find that business broker who's going to know folks in your community who are looking to buy a business, and it's going to be less hands-on. The due diligence is going to be a little bit less involved. And so through that process, finding someone who knows people in the community who are looking to buy, that is going to be a better opportunity. Now, once you start getting into, $5, $6, $7 million in annual sales, then looking at a banker starts to make a little bit more sense.
Okay.
It is tough sometimes to say, like, if you've got a company that's making $1 million a year, that's great. but the extent to which there's going to be a market out there, it could be limited because again, you got to ask, what are you selling, right?
Right. I just recently purchased a powder coating operation, and
remember we talked about this.
Yeah, and when I walked in, I could immediately see, and he was maxed out. He built it from very small operation to, a decent size, pretty big building, pretty good contracts, but they're all handshake contracts. I'm like, well, where's the value? What am I getting? One of the things that I was surprised when we went through the process was, we had probably $1 million of equipment inside this building, big ovens, big spray booths, like equipment. And when we went to the evaluation, the evaluator said, well, that doesn't count in the evaluation. You had to have that equipment to make that revenue. So that doesn't count. Now the building counted, the land counted, but the stuff inside, what I was surprised at, he's like, I've got, he tried to throw another number. And the only number that helped on equipment was like we had extra motors or we had inventory that could count. But the actual equipment, and to our industry, vans, equipment, cameras, things inside that help us make revenue doesn't really count for the evaluation. Is that standard, or is that just the deal I was in, or what's that like?
Yeah, the whole point of the way that a lot of these valuations tend to occur, right? So as we talked about throughout, when we talk about EBITDA, that is really talking about your ability to generate earnings. It's not looking at the assets that you actually own, because again, if someone is coming in to a business to buy a business, they want to buy the business. They don't want to buy the assets. Now, if you wanted to go in and say, hey, I want to buy your equipment, that's something different. But if you want to say, and there are differences between stock purchases and asset purchases that you'll deal with when you're determining the structure of a sale. Each one has a different benefit, but selling equipment is very different than selling a business, because again, you're talking about, when you're selling a business, your ability to generate sales, your ability to generate that profit. And so the equipment is part of doing that.
So that's interesting, because that's how it was for me. And then, but also for me as a buyer, I could see where he was falling down, and I knew if I put our team in there, we could double or triple, and it has worked out that way because you get to see potential in there. So I probably paid him more than the initial valuation was, because I could see how much he wasn't doing and what I thought we could do. And so that was a different, I'm more of a strategic buyer because I knew what we were doing there. Quick comment from Chuck Roadhouse. He says, you need a 5-year plan, no debt transfers. Chuck just recently sold his business in Maryland. No debt transparency in accounts, have service contracts and equipment that is not worn. Then it's what the market will pay. Have other investments, but never put all your eggs in one basket. That was his advice from what he just did.
I think that's sound advice. And yeah, the 5-year plan is critical. It goes back to what I said earlier. You can't wake up one day and decide you want to sell your business. It's figuring out, what is it that I want to sell in 5 years. I think that other point about no debt transparency, right? Ultimately, when we put out our marketing materials and we have a balance sheet out there, we don't detail out debt at all. We don't even include it, because it's really not relevant to the buyer, right? Because they're going to pay you for your business, and then it's like selling a house, right? You're going to pay off your lender, and you're going to take whatever equity you had in your home and pocket that. So it's similar to selling a business, right? Whatever debt you've incurred, you're typically going to pay off your lenders. They're not going to accept your debt. So whatever you're taking on you're going to net out whatever that is.
So there was a question. Corey Flowers asks, he says, you got any tips for devaluing a business if you're going through a divorce? How do you make it look like it's worth less? I think a lot of people, that's an interesting question. I mean, I don't know if that's an ethical question, but have you ever run into such a thing?
Yeah, I'd like to think that I'm in the business of maximizing value, not the other way around. But
sorry, Corey.
I'm sure you can find some folks out there that are going to be helpful in those circumstances. Whether that's an accountant
divorce
or an
attorneys. Yeah,
that's right.
So I another question you hit on earlier was, look, you've got some good people with you. I've got a lot of people with me, been a long time, and I'm not even close to. I've had these conversations, and for some reason, some of my people think I'm about to sell my business. I'm not, but I just know that you have to begin with the end in mind. Or as I'm 55. I know that I can see the end more than I can see the beginning, right? I've been in this 37 years. So what does that look like for me? And a lot for me, I'm mostly backing away from the day-to-day operations and enjoying life a little bit, but also just kind of overseeing the business. But what do you do for employees that they're still in the business, and they've fought a lot of battles with you, they're right there with you? I've heard some people kind of give them some percentage going into the sale so they benefit from it. I've heard that Built to Sell read that book, and he says, hey, have an agreement with them ahead of time. It kind of comes out of my payment, and I pay them to stay on. Like, what would you say for employees that they want to stay around after you're gone?
Yeah, and it's always going to be case by case. A lot of companies will set up ESOPs, employee stock ownership plans, ahead of time to start kind of getting some of that ownership. Although it can be structured, is not usually going to be common shares and some kind of preferred share that you're going to provide. There's also ways that I know that some folks, when they sell their business, they just say, well, I'm gonna provide some of what I earn to some of my key employees. I'm trying to think of other ways that you can think about this. In most cases, right, it's going to be up to the buyer to retain employees because.
Right. I was told that they should put an offer across the table that's fair and equitable to your people. That if you sell, that they're going to keep them on at a good wage that's agreeable. And to your point, who's responsible? When I bought this last business, the guy didn't tell anybody. It was like, surprise! I'm selling. I'm out. Here's the new owner. Meet Mark. And I just would not want to do that. I'm not going to do that.
Yeah, that's a tough one, right? Because you've got to balance a number of things. One, depending on the type of business that you're in and the way that your customer contracts work or your relationship with your employees work, you don't necessarily want to put them through the whirlwind of saying, all right, I'm thinking about selling my business, because then they're always waiting for you to sell that business, and they're waiting to find out. And that adds a little bit of turbulence. It adds uncertainty about the future. And it can make it more difficult, depending on the level of trust and relationship you have, to retain some of those employees. Because if they know that I really like working for Mark, and I don't think I want to stick around if he's not going to be here later, going forward, they might start looking for other options. And that doesn't really help you when you're trying to tell your new owner or your buyer that this is your team. Because you can get we'll get the question from buyers, which is, well, what's going to happen with the team? What's going to happen with management?
Right.
And we'll say, well, for one thing, that's up to you, right? Like, are you willing to pay them enough to keep them around? Are you willing to maintain the culture that helps, Mark or whoever the owner is to retain? Because as particularly services, employee retention is very difficult. It's not something that just, you pay somebody and they keep showing up. You've got a mentor. You've got to make it a working environment that they actually want to show up to, particularly today, because they can find work elsewhere.
Exactly.
That's going to be the same thing that whoever buys your company is going to have to think about. Do they want to retain employees? If they do, they got to pay them. They've got to make it worth them staying. Now, as far as who you tell on your management team, we talked about due diligence earlier, right? So you can do due diligence all on your own. You can be the one who's, giving all of the financial information and being responsive to those requests, or you can have a controller, an accountant, a bookkeeper, or something like that. You can have an operator, your COO, or whoever it might be on your management team. You can bring people into this process that are going to help to spread some of the load around. And if you've given equity to some of those folks in the past, they're going to have buy-in to this process as well, because they see the opportunity to liquidate some of their earnings and do so at a significant premium. So there's no one answer to this question. But there are options. There are the ESOPs. there is, finding folks that you want to maybe get some equity interest in your business.
Right. That's interesting. You said that, hey, it's really up to the buyer to keep them. Let me ask you this, and we're getting out of time. If you guys got any more questions for him, I've got him for an hour. Super valuable stuff, but I want to respect your time too. So, oh my God, I just forgot what I was going to say. It was about keeping me, say they want to keep me on. Like I was with an attorney, they were going to, a private equity firm was going to buy their law firm. And that private equity firm wanted all the lawyers to stay on for 4 years. And they were locking them into a 4-year time frame. When we've been entrepreneurs, I know I will not be able to work for somebody else for that many years. So the first question is, what's a normal amount of time for an owner to have to stay on, if there is such a thing? And secondly, I've heard that a lot of guys that sell their baby that they started, like me, kind of go through a depression or kind of go through a, man without an island, like a man without a country feeling where they've sold who they are. So the last two things that can you help us with that? How long should we stay?
Yeah. So how long you stay on it's going to be part of the negotiations, right? And it goes back to something I said earlier through this process is, as an owner who is anticipating or contemplating a sale, you need to know what it is that you want. And you need to communicate that on the front end. What we want to be able to tell a buyer is that management and owners particularly owners, because management you want to retain typically, they're willing to stick around long enough to ensure a successful transition.
Yeah.
So that could be 6 months. That could be 12 months.
It could be 2 months. The guy that I bought it from, I couldn't stand him to be around. I said, "You're done. You're out. You can't be here anymore."
Yeah. Well, and that's often how it works, because and you said it earlier, you go from running your own business to now trying to answer to somebody else. It's rarely is it going to work. Now, on the other hand, if it is if you are purchased by an independent sponsor, some kind of financial buyer that is going to leverage you as a platform, it could be different, right? They might say, look, we're going to help you de-risk. We're going to put the money in your pocket. We're going to let you retain some equity in the business, but you're still going to be responsible for running the day-to-day. Or what we see in a lot of cases too, folks that are been running their business for 37 years, more or less, they've typically gotten to the point that they're not so much day-to-day anyway, and they're kind of they're setting the strategy. They're putting out fires when they need to, but they're not really doing that day-to-day work. They've found others to do it. So
let me just say something to that. I had some friends in Sweden, and Chuck Hall, who's on here, knows what I'm going to talk about. There's a private equity company that came in and bought tons of chimney companies in Sweden. They rolled them all up. And my friends that sold them, they said, "Hey, we're going to buy your company." And I guess they paid them well, paid them a lot of money, but they had to keep them on and basically hit certain metrics. And as long as you hit certain metrics, he said it wasn't anything crazy, but that's how they kept them on. But basically they all sold their businesses to this one big firm and stayed on, and I don't know how long it was, but he's paid a salary to keep it up. I think it was for a few years. Is that a kind of a standard?
Yeah, it can be. And again, it's all circumstantial. It's what is the strategy and kind of the approach of the buyer, right? Do they have a management team in existence? Are they adding or tacking you on to an existing business with an existing management structure? Because in those cases, they probably don't need you to stick around. Again, if it's somebody who's a financial buyer, they might, and if you are an owner and are still very much an operator, yeah, they're going to want to stick you around because you've got the secret sauce to whatever it is that's made you successful.
They don't know what they're doing. They just like the numbers.
That's right. So yeah, it varies. And I would say one other thing too, and it kind of gets back to the question of how do you know how valuable you are? Remember that the financial buyers that are out there, and you mentioned it with you said Switzerland?
Sweden,
sorry. Got mixed up for some reason. So when you have those types of roll up, you've got buyers out there that are going around and they are finding every business that's operating in this vertical that they're investing in.
That's right.
Are you getting approached by buyers currently? If you are, that's a pretty good indication that there's interest in what you're doing, that there is value that people want to buy. There was an article recently, and I know we're running up on time, about the roll-ups of car washes. Because in the past, car washes are, great business. It's not too, the marginal cost on your next dollar sale isn't that great. And you can really generate a lot of cash, but there really wasn't any consistent revenue there. It's just kind of certain times of year, people aren't washing their cars. So you have these big lulls. And so what some of the folks that started rolling this industry up realize is, well, what we can do is build these kind of subscription models where we charge $16 for a car wash, but you pay us 20 and you have unlimited car washes for an entire month. Because what does that do? It says, well, we know that we're going to have X number of subscribers every month paying us $20. Most of them aren't going to use $20 worth of car washes. And so once they built that model and they were able to build the metrics, build the programs around it, they said, okay, this is a great roll-up opportunity, and they start buying them all up. I think it's similar with HVAC services. So once someone sees and buyers start to identify ways that they can really start to build sales growth, sales sustainability within an industry, that's when you're going to start seeing a lot of roll-ups. That's when your phone's going to be ringing off the hook because people are going to want to buy you. And I'll go back to one final point on that. And I think I mentioned it earlier because when we were talking about people knowing who their buyer's going to be, never sell to the first person who asks you to buy, because what they love to do, and part of their business model is, let's get that proprietary deal, right? Let's go to someone we're going to, you're in the weeds of your business. You're not always seeing the forest through the trees. So, you're not taking a step back and saying, what is my company actually worth? You're not having an evaluation necessarily. So someone's going to show up and they're going to put a number in front of you that's going to look pretty good.
Yeah.
But you know what? If you were to run, and what we see is when you run that competitive process, you will have that buyer who showed up earlier. Very likely they might come to the table and they're going to be paying 20% more or offering 20% more than they were when they just approached you on their own. So that's one thing to consider. If you know the interest is there, your phone is ringing, that's a really good time to not accept that offer, but start talking to an advisor about what your options might be, because that's when that strategy is going to be a little bit easier to identify because the roll-ups are happening.
Man, so good. A lot of good information here. I
hope so.
I get contacted for the business, but I think you hit on something here right at the end. That's almost everybody listening. I hope you picked up that gold nugget you just put down. If we can figure out a good subscription model in this chimney industry, all of our businesses will get more valuable. If we can figure that out and share that, like you just said, have a model that works for everybody, then all of a sudden our businesses become more target rich environment that we could all do better at, because we've spent a lot of time on this, but we're not good at that one thing that you just said could make your business very valuable. So,
well, as you know, that generating that next sale can often be very expensive. And so when you've got that subscription model, that recurring revenue, that's when you're really building value, because you're no longer having to sell those customers you've already gotten.
Yeah, that's so good, man. Thank you so much, Garnett. You may have to come back a couple of times. We had really good content. We had people asking and a lot of questions, and you have really good information. So thank you for doing this.
Well, I hope so. It's been great for me too. And I hate situations where I spend the whole time talking. So I'd love to actually be able to sit down and learn more about exactly what it is that's happening in the chimney sweep industry, because it's not something I've had a lot of exposure to other than our discussion.
Yeah, well, no one has, right? We're kind of this hidden little industry that has very passionate people and mostly, relatively small businesses, but we're all growing and we're all trying to figure it out ourselves. And one thing that's good about our industry is we're really good at sharing information. Like, we're not like in our own little silos and trying to hold information. We're really good at sharing it so we can all help each other. It's just kind of something that's in our blood. I don't know why. It's just become that. And one last thing to your point about ESOPs. One of the big suppliers in our industry just did an ESOP sale to their employees, and he was talking about good and bad about that, but that's what he did, because he really cared about his people, and he made a situation where he could sell that. And I haven't heard if it's good or bad now, but I know at the time it sounded very interesting to me. So
it's an option to look into, certainly.
Yeah, there's a lot of options, right? I think it sounds like the biggest takeaway too is, if you're thinking about doing it, the earlier you start this process, the better. Like, when you have plenty of runway is a better time than when you're at the end of the runway and you need to get out right now. The fire sale of a business, it sounds like it's pretty bad. The planned sale of a business, you got more likelihood of maximizing the sale.
Lay the groundwork early. That's right.
Yeah. All right, buddy. Hey, thanks. Have a good night. I just signed up for next year's IndyCar race where we're going to be. Hope you're there next year.
I hope I'm there as well. It's one of my favorite weekends of the year.
Yeah, it was great. All right, man. Have a good night.
All right. You as well. Thank you.
Oh gosh, I hope you guys enjoyed that as much as I did. Just fantastic information. I hope, our industry is kind of coming to that. Also, some of you guys may want to sell to other people. And so to get the most out of it, what do you do? So hopefully you got a lot out of that. With that being said, we will see you next week. I'll be back here on Tuesday night at our regular time, and we'll talk to you then. See you later.